What if I tell you that I can take a 100x leverage trade and still not be considered a reckless trader? Well, I'm gonna give you that, how to do that exactly, but also I'm gonna show you everything you need to know about leverage trading. Now, my name is 𝗬𝗪𝗍𝗪. I'm one of the new kids on the block. I'm here to help you make money in every way of crypto other than trading, but leverage trading is something that we all have to consider because it is the bull market. There are two types of people, the people who leverage trade and the people who want to leverage trade. So let's jump into it. If you're new to this channel, please smash that subscribe button. Also, if you're returning, please smash the like button and let me know in the comment section what you think about this show. What is trading? That's exactly what we gotta start with. Trading is buying and selling. It is the bull market. Basically, that's what it is. Sorry, but that's what it is, buying or selling an asset. If you're leverage trading, that means that you are buying and selling an asset for US dollars, right? I see you guys in the chat as well coming crazy. That's absolutely incredible. See you guys, awesome, awesome, awesome. Let me know, how are you? Let me know if you're leverage trading. I actually put up a vote as well. I wanna know if you are leverage trading. It is the bull. 74% of you say you are leverage trading, and that is absolutely incredible. I wanna give you some guidance today. So let's jump into it. So again, going back to the example, trading. Trading is when you sell and buy an asset. That's obvious, right? Leverage trading, you also buy and sell an asset, but the difference is that you use someone else's money. So if I go on and look at what leverage trading is, I see here the vote, by the way. 70% of you leverage trade. That's great. Let's see if you get this right. Let's see if you get all the stuff right. So leverage is, what is leverage? Leverage is to use a borrowed capital for an investment, expecting the profits to be made greater than the interest payable. Now, this is great, but what is it in leverage trading? Leverage trading is a strategic technique employed by investors to amplify their exposure to an asset, allowing them to control a more substantial position size than their initial capital investment. Now, if you understand this, I'll just go home, turn the live off. Let me know if you understand it or if you don't understand it. For me, when I started out, it was completely beginner. So, what this means is, leverage trading is a strategic technique employed by investors to amplify their exposure to an asset. That means that by the use of leverage, you are able to increase your exposure or your position size in any asset. So leverage itself is the borrowing of capital from the exchange. How do you do that exactly? Basically, right now, everything works with a click of a button. But when you use leverage, you essentially borrow money from an exchange. So in traditional ways, we talk about leverage as 1 to 5, 1 to 10, 1 to 20, and that means that you're borrowing money. So for example, if I have $100 and I want a 10x leverage, $1,000 worth of position, I can borrow $900 from the exchange and put that in use without using my money. If I bring a casino example, this is how it would look. There is a big poker table. You come to the poker table and you say, I have $1,000, but I would like to play with $10,000. The casino can tell you, obviously it's not happening in the real world, but the casino could tell you, okay, we can give you $9,000 as a loan, no problem, but you cannot lose any of our own money. So you can only risk your own money, your $1,000. You take that $9,000 and basically you use a 10x leverage at the poker table. Until you make money, that's absolutely fine. The casino takes their cut and everything is happy. But when you start losing money, the casino tells you you can only lose $1,000. If you lose more than $1,000, they will cut you out. You lost all your money and you will have to give back the $9,000. So that's exactly how leverage really works. So when you say you're working with 10x, what essentially that means is that you are borrowing money and you are using 10x the money that you have. Let me give you an example here. So for example, I go and I take a 10x leverage position on Bitcoin, right? So I have $1,000. If I have $1,000 and I take a 10x leverage position, that means that now I have $10,000 worth of buying power, right? So that's what I basically have. But here is the kicker. When I use 10x leverage, everything multiplies. So also my gains multiply and my losses multiply. So if price moves by 1%, I lose 10%. And I don't lose that 10% on my position size, but I use it on my margin. So in this case, if price would move 1% to opposite direction of me, I would lose $100 on my 1,000. That is the risk and the advantage of leverage as well. I'm going to talk about it in a second. I just want you to understand the basic concept. So if I have $1,000, I come to the exchange and I want to use a 10x. Somebody saying in the chat it's risky. People are saying it's risky, it's risky. I'm going to give you why it's not risky. I'm going to give you why it's not risky. So, I mean, it is of course risky. Everything is risky in life, but I'm going to give you why you can use this to your advantage. So if you have $1,000 and you do a 10x leverage, you have $10,000 to purchasing power. You can purchase $10,000 worth of assets. But if you, for example, do 10x leverage, you can also do from this 1,000, you can also do 100, and you still have 900 on your account, right? That means that you can cover the loss if that happens. For example, if you have 1% move in the price, and the price moves 10% against you, that means you lost $100. Going back to the poker table example, if you go down to the limit of your own cash, which is called the margin, you lose everything. If price goes down 10% in this example, if you're at 10x, you lost everything because 10 times 10 is 100 and you lost all your margin and you get liquidated. This is what we call liquidation. What you have to understand from the whole thing is using leverage basically means that you are multiplying your cash, your gains and your losses. Now let's talk about gains and losses because this is what a lot of people get wrong. Again, I will bring you the example of $1,000. If I have $1,000 margin and I take a 10x position, I bought $10,000 worth of assets, right? My position size is $10,000, all good. If price moves up, I'm not going to talk about it that much because if price moves up, you make money absolutely fine. 1%, you make 10%, that means you make $100. But what if price starts moving down? If price starts moving down, you will lose multipliers of the percentages of the move. So for example, if price moves down 1%, you lose 10%. If price moves down 5%, you lost 50% of your margin that you put into the trade. At 5% in crypto is nothing. You guys know it. All of us know it. 5% happens basically, from an hour to an hour. When it goes down 10%, you lost 100%. Here's going to be the differentiator because there is isolated margin and cross margin. If you use isolated margin, you did not you lost everything, and if you lose cross margin, you haven't. I'm going to talk about that in a second as well. This is when actually liquidation happens. I'm going to explain to you when we get to the exchanges. There are two major things you have to understand and people ask a lot. Number one, funding rate. So when you take a position, when you take a long position or short position, you have something called the funding rate and the funding fee eventually. This means, let me show you it on an exchange. This means that when you take a position, it will show up as, for example, now on Bitcoin, the funding rate is 0.016%. This means that if the funding rate is positive, longs pay shorts. If the funding rate is negative, shorts pays longs. So whenever you take a position, it sounds very nice that you take a long position and you hold it forever and ever, but if you look at a funding heat map, for example, funding rate heat map, you can see that holding a leverage position for a long time can be very, 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 very expensive. So Ren, for example, liquidated, you saw him on the show, he liquidated his position because he closed his position. He didn't get liquidated. He closed his position because he paid too much in funding. It was worth for him to put it in spot. That's the exact same thing here. So if you look at the funding rate, you can see that sometimes funding rates can go very, very high. Funding rates are payable every 8 hours, by the way. Funding rates can go very, very high. So high so that at some point, for example, in March 5th, you saw that it's a yearly, so you didn't pay 200% on your position every 8 hours, but this heat map takes it for a yearly. If things wouldn't have changed on the 5th of March, people who held Link, for example, and were short, long Link, they would have paid 188% of their position as fees because this helps the market to equalize. If funding rates are high, then there is an incentive for the other side to participate. For example, if the funding rate is positive and it's 188% in a year, then there will be more shorts because then they get paid that fee. If the funding rate is negative, then there will be more longs because then they can recoup the fees from there. So this is just about funding fees. The other thing that we always talk about is open interest. You probably hear Rand talking a lot about this. Guys, smash that like button. I see we have almost 800 people live and we have 134 likes. Smash that like button if you like this content. And if you're new, you know what to do. Subscribe. So, open interest. This is basically, so open interest shows you can find different websites where you can see open interest. There are trading view indicators and whatever that is, but basically what open interest is is the opened positions, the number of opened positions on different exchanges on different assets. So when you come here, you see 111,000 BTC, but that's not 111,000 pieces of BTC, or not $111,000 worth of BTC. It is 111,000 orders that are opened on Binance on the BTC pair. If I go into Ethereum, for example, you will see 661,000. 661,000 on Bybit, but it's 1 million on Binance. That means 1 million positions are open. Why is this interesting? It is interesting because a lot of times you talk about open interest went down. That means that people lost interest in the market. They are not participating in the market. There is no real player. So if the open interest is very high, and you see it going by hour, by 4 hour, by 24 hour, you know that there are active participants in the market. And that means that they just come, they place an order, whether it's short or long. We could see that from liquidation heat maps, but we're not going to talk about it. But when open interest is reset, that means that we wiped out everybody basically, right? So we wiped out the participants. Now we can start building again. And that's also what funding rates shows us. So when we're green, we are more neutral. That means that there is not really either side of the market. It's not really, longs and not really shorts. It's like a neutral side. So, yes, let's talk about why does leverage not matter. So as I said at the beginning, I could take a 100x leverage position and still not be considered a reckless trader. And this is something, guys, I really want you to pay attention, because whatever I'm giving you here is real alpha. What is most important in trading? Risk, right? So we have to evaluate our risk. This is why I always say leverage doesn't matter. What matters is risk. Risk is what matters. If I take a 100x leverage position, what does that really tell me? It means that I have let's say I have $1,000, right, as my margin. Margin meaning my own amount. That's like my money. And I go into an exchange and I take a 100x leverage position. That means the exchange will borrow me 100 times the money I have, right? So I'm gonna go in with a 100,000 USD position. Here is where the problem becomes an issue, right? If let's take it with smaller numbers because it's gonna be much easier to understand. Let's take a 10x. Let's take $100. So that means we have $1,000 position. Here's where the interesting part comes in. If I have on the chart, I put my risk reward tool up here and I say that my risk is 1% on the chart. If I take a 10x leverage position, my risk is not 1%. My risk is 1% times 10 because I'm using 10x leverage. If I take 100% or 100x leverage, then my risk is 1 times 100. So whenever you start plotting your trade, you start putting your, you look at the chart, you start plotting your trade, you start putting your risk reward tool up, and you're thinking, what trade should I take? Or you get an information from someone and saying, oh, this is my TP, this is my stop loss, this is my position. You always have to consider using leverage. What I saw people, and this is what I've done in the beginning, right? What I've done in the beginning, I got a call, okay, go and buy Bitcoin long, 65,270, stop loss below 65,000. And I did 20x all my account and then that's it. But what I didn't realize, if I do a 20x on my whole account, is that I basically can use 20% of my total account on one single mistake, right? One single mistake. So what matters is not the leverage, because the matters is not the leverage, but the risk. So let's imagine that I have $1,000 worth of account. That's my account size. That's all the money I have in the account. And I have a 1% risk on the chart. If I go in with my whole account and I put it at let's say a 10x, that means I will lose 10% of my account, of my total account, if price moves down to 1%. If I do a 100x, I will lose my total account if it goes down by 1%. But what if I would go in, let's say I'm just gonna plot it down here for you. What if I have a $1,000 account, right? I take a 100x position, but I don't take it with my whole account. I don't take it with my whole account. I only take it with 10% of my account. So I take it with $100. That means that if price moves 1% down, 1% move, I'm gonna lose 100% of the amount that I put in the trade. So yes, I'm gonna lose 100% of my account, but I'm only gonna lose it on the trade that I added, or the margin that I added to that trade. This is when you can see like people posting 2,000, 5,000, 7,000% cards and wins on Twitter. The reason, or the way they do it is that I can take a $1 position on 1,000x, and even if I lose, even if price goes down 10%, I'm gonna lose $20, $30, not an issue. So what you have to consider is always not the leverage that you're taking, but the leverage you're taking compared to the risk that you're taking. Now guys, let me look at the chat as well. I have been just talking and talking and talking. I love to do these lives. I had some technical difficulties in the beginning, but completely back here. Someone is saying forbidden in the EU. Leverage trading forbidden in the EU. Now here is the thing. I'm very glad you said that, because now we're gonna move on a little bit to exchanges, right? And how to use them. I'm gonna show you exactly how to do this, because I know people get themselves wrecked completely. So if you think it's illegal in your country or whatever, again, not financial advice, nothing I say, or you just want to regain control without centralized exchanges, I brought you 𝗍𝗢, not a sponsor, but I think 𝗍𝗢 is a decentralized perpetual trading platform, right? So that means that you can trade on leverage and you can trade options using your MetaMask. Absolutely incredible. The idea itself is absolutely incredible as well. There is a link in the description, check it out. What you can do is that you hook up your MetaMask account and you are able to do leverage trades decentralized manner. You don't have to KYC. There are no country limitations. It's a complete decentralized ecosystem of trading options and leverage trading. Works the exact same way. You hook up your MetaMask and then you can take a trade. I'm actually just gonna take a trade here so you see how it works. So for example, I take $100. We're gonna talk about this in a second. For everybody who is using centralized exchanges, I'm gonna explain to you everything on another exchange, how these things work, more course margin, isolated margin, everything in a second. But you can take a position here. You can just add how big your position you want. This is the position size. Again, we talked about leverage. So I'm at 20x here. It shows here, position size, and then I just go place an order. The cool stuff about this is that it literally places it from my MetaMask. Like everything I do goes directly to my MetaMask. It's absolutely incredible. Anyway, check this out. It's also important when you want to preserve your privacy, right? So privacy for me is absolutely key. And this is why I want to bring in today's sponsor, ZKML. The reason why I'm bringing them in, I have been invested in this project since February. And they came to us and they said they wanted to sponsor a show, and I was absolutely happy, because I am very, very bullish personally on the project. This is also disclosure that I am holding this token. Instead of giving you why I think they are cool and whatever that is, I want to give you why I personally invested and why I personally have huge, I would say extremely bullish, but I wanted to say belief in them. And the reason is everything is crypto, right? So if they can pull this off, this can be absolutely mind-blowing. So what they say on the website, unlocking privacy, secure blockchain communication, and cross-interoperability. It's a very difficult word, but basically means that you can do it through all the blockchains. What they do, they take a holistic approach to privacy. And that means that if you do anything, if you search online something, I don't know if you had this experience, you search online on Google, for example, and you get literally a second later, you watch a YouTube video and you get the same, advertisement that you were searching on Google. And because Google basically owns everything, or Google and Apple, your privacy is completely gone. Absolutely gone. Whatever you search, whatever you watch is already connected in the back. You have a profile created on your persona, and they give you and feed you everything you want to know. So what they're planning on doing, or what they are aiming to do through a complete ecosystem, is to preserve your privacy. First off, they have ZK search. What they, again, talking about going back to the example with Google, they have a decentralized search engine powered by AI, and that means that they don't store your data. So you can still get everything else that you would get from Google, all the information available worldwide. You can still use them, but there is no profile being built on you, and they can't leverage it against you, or advertise you stuff, for example, that you don't need. Then they have the operating systems. If you use Apple, I don't even have to mention this. I mean, if you use Apple, obvious, any operating system you use collects data. I literally, oh, by the way, guys, just so you know, if you use an iPhone and you have this journaling feature on, I literally just saw it yesterday. If you have this journaling feature on, it allows the journaling feature to share the journaling experience with other iPhone users in your area. So this is the kind of stuff that ZKML is fighting against, right? So also for computer or for mobile. Then they have a privacy-centric VoIP, which is voice over internet protocol, meaning when you have a phone call, again, this is why I'm actually extremely bullish on the project, because if you think about this, how many times it was confirmed that we were being eavesdropped by the government, right? Everybody's listening to what we're talking about. their approach will, or if they pull it off, they will be able to create an interface where you can communicate without being tracked completely. Then they have the shield, then they have cross-chain interoperability, which means that it's not just gonna be, if you use Monero, your privacy secure. It's gonna be like you can use any blockchain, and they pack it. They have a special D app that you can already test out. Basically, what they do is that you can go and, oh, I have to refresh the site. Sorry about that. Basically, what they do is that they pack your, they give you a public ID, and they pack your transaction in a package, and nobody can track your transaction, even though if you are interacting on Ethereum, for example. You can go in, connect your wallet, try it out. You get your ID here, and then you get your key. Obviously, I'm not going to show you the key, and then they pack that transaction. If you want to know more about them, read the white paper. I read it. They have everything explained, everything how they unpack this, what the features are. Again, this is just my personal opinion. I'm not financial advice. I am invested since February. I love the project, even though before they became sponsors. You can check them out on DEX Tools. They did not have a centralized exchange listing yet as well. I would be very, very surprised if they don't have it. Basically, I just keep track on their Twitter after invested. Let's talk about exchanges, because it's very, very important to understand how to actually do the trades, how to actually take leverage trades. Oh, Bitcoin is pushing, guys. Who is long? Who is short? Who is long? Who is short? Okay, people are mostly long. People are mostly long. Okay, that's a very good sign. That's a very good sign. All right, so I'm gonna use 𝗏𝗏 as an example. The reason why, again, I just bring something that I like to do, and I use 𝗏𝗏 because 𝗏𝗏 is freaking amazing. No KYC, no KYC, non-custodial. They don't keep your funds and all that. You can check it out. There's a link in the description. This is what I use, but it works on the same way on any centralized exchanges that you might use. So here's how you do it. Number one, you want to transfer funds, right? So you have different accounts and exchanges. If you have not done leverage trading, it can be intimidating. I know it's difficult, but I'm gonna give you the tools now, and don't get scared, okay? So there is, if you go to the assets, you have different accounts. You have funding, you have spot where you hold your Bitcoin and whatnot, and then you have futures. So futures accounts is what you really do. Now, it's important to mention here what is futures and what is margin and what is leverage and whatnot, because it can get quite confusing. So in crypto world, when you say futures trading or perpetual trading, or even if you go on to TradingView, you see when you search for an asset, you see the P at the end. This is the charts that you want to look at if you trade perpetuals. Perpetuals, I don't want to get into the deep dives, but basically what it means is that it's a derivative. It derives the price from the underlying asset. So what you want to know here is that in crypto land, everything is basically compliant. Future contracts are an agreement that I'm going to buy or sell you an asset down the future on a specific date and a specific time. Now, perpetual futures allow you to do that without time limitations. And that means that we agree, the exchange basically agrees with you that they are going to buy or sell the asset that you are taking a position in without time restraints. That means that I can get in a position and sell it or close it a year from now if I can bear the funding fees, right? So here is the somebody's saying I'm long. Chaos in the house, yo. Everybody's long. That's not. Oh, somebody's short. Daniel is short. Okay, good. All right, so let's go into this. So first, what you want to do is you want to transfer funds. So when you have you send the whatever USDT to your account, you can click on this little arrow, and then you can go from funding to futures, right? You write in the amount, and then the amount will show up here. So once you've done that, you can start taking trades. Not financial advice, obviously. First off, you can find the pairs that you want. If you chart your chart, don't go. If I write in Bitcoin, for example, on TradingView, you will see that you have BTC USD. You have simple BTC market cap. You have all that. What you want to look is always the perpetual. The P at the end is very, very important. It even says Bitcoin, Tether, USDT, perpetual contract, right? So you always have to look for the perpetual contracts, whatever exchange you use. So once you've done that, you can go on to the exchange and search for the actual pair. So when you are up at futures, when you pick the futures, not spot, not margin, not anything else, you can search for the asset that you want to trade. Let's say you want to trade Bitcoin. If you want to trade Bitcoin, you will land on this platform. The platform is basically the same when you purchase spot. If you have ever purchased spot, you know what I'm talking about. If not, you have the chart here, you have the order book here. as a beginner, it's very, very important to understand the order book. Is very important. You have all the orders lined up, but I don't want to deep dive into it because it's a completely different topic. But you see all the sell orders here in increasing order, and you see all the buy orders here in decreasing order. And then what you can do is select cross margin and isolated margin. And now I'm gonna look into your eyes and tell you to please stop everything you do and listen to me, because this is where people really get screwed. I wanted to say the F word, but screwed. When you use cross margin, again, you can set it up here, look. When you use cross margin, it even says here, I'm not gonna read this, but it says here what it is. Cross margin means that you are using your entire account, futures account, is at risk. So if I have, let's say I have now here $7,000, right? If I put a trade, I explained to you the example with the how much can you lose and what account I'm going in, and if I have a 1% risk on the chart and I go 10x, that means I can lose 10% of my account. Well, if you use cross margin, the amount that is on your account can be used as collateral as well. Let's take an example. I have $7,000 here. I go into a trade with $1,000 at 10x leverage, right? That means if the price goes down, I lose 10%, fine. But what if price goes down 10%, right? 10 times 10, I lose 100%. I lose 100% of the $1,000 that I put in. Now, if I am on cross margin, I can go in minus. So I can literally have a minus 400% position because it takes the amount I have on the exchange as collateral and it uses it as collateral, meaning I can have a minus 400% position even though I thought I'm only risking the money that I put into a trade. However, if I use isolated margin, which is here, that means that it isolates that position. If you put in $1,000, there is no way for you to lose more than $1,000. If you are starting out, please make sure to use isolated margin. Never use cross margin, never, because if there is a flash crash, you will lose your whole account. So only use isolated margin, please, 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 okay? So that's the difference. Let's see how it goes. You have limit orders and market orders. Market orders are more expensive, but still, I recommend you, if you're a beginner, to use market orders. Market orders means you don't have to worry about the order book. You just simply put in, I want to buy Bitcoin now. I want to buy $200 worth of Bitcoin, and it will fill you the best price, on the best price. On the limit order, you will need to add the price as well. So you will need to add what price you want to purchase on, but if the order book is moving too fast, your order will not get filled. So that's why I think if you're a beginner, stick with market. Then you can write in, let's say I want to buy $100 worth of position. Let's say 1,000, and I'm fixed at 50. Yeah, sorry guys, because I'm, I did a trading show the other day on. By the way, guys, yeah, you should follow my trading channel. It's live in the description. I have a trading channel where I teach all that what you heard and much more. I have live trading shows. I give away profits and whatnot. If we reach 2,000 subscribers this week, this Sunday, basically today, I'm gonna do a major giveaway on my show on Monday. So subscribe to the channel down in the description. But anyway, what I wanted to say here is that if you go in with, let's say, a 10x, you pick the leverage that you want, and you add the amount, let's say $1,000, it will show you several things here down. If you see it says cost, the cost is the amount of money it will take from your account and use it for the trade. So in this instance, when you say $1,000, you don't put in the $1,000 does not mean that you use your own $1,000. It means that is going to be the position size, which means if you're going 10x, then the position size is 1,000. Therefore, 10% of that is the money that is going to be used from your own budget. That is the cost here. So if I put in $1,000 on 10x, I will have to use $100 from my own account. Then there is something called the liquidation price. This is what I told you. What it means is that if you use a isolated margin, for example, or if you don't have enough money on your account, it will have. So for example, if I would put in, let's say, I don't know how much we should put in for it to show the liquidation price. Yeah, for some reason it doesn't show it to me because I'm not an isolated, I'm cross. But anyway, so it will show you a liquidation price down here, right? Let's go. Let's see if it shows it like this. Yeah, here, you see? So if I would go in now, I would put 72% of my capital, and I would go long my liquidation price would be 3,228. So that means that if I would go in now, 50x, 72% of my account, if Ethereum dropped down 3.5%, I would lose my entire account, everything I have in there. So always pay attention before you place a trade to know what your liquidation price is, right? And then you can basically just take the trade. Now there are questions that I usually get going long and going short. The good part about leverage trading as well, other than the fact that you can borrow the exchange's money, is that you can go short and you can take a long position even on assets that you don't own. It's because if you buy Bitcoin on spot, you go long on the position because you swap your USDT into Bitcoin, and then Bitcoin appreciates in price. You're basically long Bitcoin. But what if you don't have the asset, you don't have Bitcoin, but you want to short Bitcoin or sell Bitcoin to take advantage of the drop? You have to get your mind around this concept. But basically what this means is that the exchange lends you Bitcoin at a certain price. You can sell that Bitcoin on the market and buy it back lower. Again, the problem comes if you short an asset that you borrowed, you will need to give that asset back on that given price. So if the price goes against you, if you short, for example, and the Bitcoin appreciates in price, you will have to use your own money to pay the exchange back, and that's when liquidations really happen, and that's why you incur losses. But when you short, it basically means that you're betting on the price going lower, and you can do that on leverage trading without having the asset. You just have to have dollars, you put in the amount that you want to buy for or the position size that you want, and then you can just click on go short. Limit orders and market makers I talked about. Stop losses, I don't really think we should talk about them, but you can use stop losses as well. There's one more thing I want to talk about before I round this up, and then let me know in the chat. Let me know in the chat if you have any questions. I will look at that. I see a lot of people asking questions. We are going to look at that. On down here, when you add the position, you will see that you have the total number of dollars. So this is the position size. Then you have average price, buying price that you bought it at. Then you have the margin. This is the margin that you used, your own money in the position. Then you have the market price, which is the current price. Then you have the P&L, and you have the P&L percent. This is what I showed you. You see, I'm up 67%. And you could say, oh my God, it's 67%. That's if you do $10,000, then you're up $6,700. But that's not really true because I only used $200. So I'm up 68% on this position. Again, this was a DGEM play on my trading show the other day. So I'm up 68%. And I'm up $137 only, right? So it doesn't mean the fact that it's a high percent. It doesn't mean that it's a lot of money. I could have used it with $1 as well. Let me look at the chat, guys. Smash that like button. All right, so let me look at it. Somebody's saying I'm confused. Let me know what you're confused with. I'm very happy to help. Someone's saying learn the charts before you leverage trade. Yes. Very, 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 very important. Please do use TradingView, learn the charts and whatever that is. Someone is saying cross is fine with stop. Yeah, the problem is if you use cross leverage and the market decides to dump and nuke, you have a problem because you can't sell that fast. You can have so for example, let me look at an example here. I'm sure we will be able to find an example on Bitcoin. It's mostly on smaller cap coins as well, but look at this. Like you can have a stop loss here. You can have a stop loss here. Let's say this was your long and you're cross margin and you have a stop loss here and you say, oh, it's 1%, I'm a 10x, absolutely fine. But what can happen is that the market nukes and it has a 10% dump. And even though you had a stop loss, the market maker or the exchange cannot fill your buy or sell and you get liquidated. So don't use cross margin if you are not 100% sure what you're doing. Somebody's saying, or wipe a few times and definitely wake up fast. Yeah, exactly. Is isolated margin better than futures? The same thing. So within futures and leverage trading, you can use cross margin and isolated margin. As I showed on the platform, look here. When you do leverage trading, which is futures trading, I explain. Go back, check the show again. Leverage trading and futures trading and margins trading, it's the same thing combined in crypto. So when you do leverage trading or margin or futures trading, you can use cross margin and isolated margin. Isolated, you are risking only the money that you put into the trade. Cross margin, you're risking your whole account. How do I get out of the trade with the profit? You just sell. You just get out of the trade. You can just close an amount here. There's a closed position and you can close that. So saying good learning, I'm happy you like it. Happy you like it. Entry is key, you need to understand the chart. Exactly. Doesn't mark price protect against crashes? Yeah, could be. I've been here long enough to see that it doesn't really work that way. So sure, it could, but it's not worth risking in my honest opinion. Guys, I believe that was it for today. I hope you understand leverage a little bit better. I hope it makes sense. I hope that you are going to pay attention to how you use leverage from now on. Again, there are two types of people in bull market, right? The ones who leverage trade and the ones who want to leverage trade. So make sure that if you leverage trade, always use isolated margin. Always check your risk. If your risk is 1% on the chart, but you use 50x leverage, you're risking 50% of your account. And other than that, I believe, so you're saying great show. Thank you so much. Thank you so much for being here. Other than the technical difficulties, we are sorted. So I hope you like this. Guys, one more very important thing. I almost forgot. One more very important thing. This is what I'm going to do from now, like going from here. Within half an hour, we got 23 minutes. The biggest meme show off the planet is going to be here on Bento Bubbles. If you are not subscribed to Bento Bubbles, guys, you are, I don't know what you're doing. Bento Bubbles as well. But Bento Plus, if you are not subscribed to Bento Plus, go to Bento Plus and subscribe. This is a channel we bring you different kind of alpha that we bring on this channel. And they're having, with Gustavo and Ran, there will be a meme coin show. I'm going to watch this now. So that's what I'm going to do. That's what I'm telling you. I think that's what you should do as well. It's going to be fun. Thank you so much for being here. Thank you so much for watching. Very educational, good stuff. Thanks for your effort. Thank you. Well explained. I'm so happy. Guys, thank you so much for watching, and I will see you in the next one.